My uncle retired at 62. He had $340,000 in his checking account. He thought he was set for life. Then one Tuesday morning, he tried to buy groceries and his card got declined. The bank had frozen his entire account. No warning, no letter, just a hold. And when he called, they told him he needed to submit 3 forms of documentation to prove the money was his, a process that took 11 weeks. By the time he got access again, he'd missed 2 mortgage payments, racked up late fees, and had to borrow $8,000 from my cousin just to stay afloat. Here's the thing, this isn't a glitch. This is becoming standard practice. And if you're under 40 right now, you might be thinking this doesn't apply to you, but it will. Because the rules that let banks do this are expanding fast, and most people have no idea until it happens to them. In this video, I'm going to show you exactly why banks can freeze your money after 65, how the system actually works, and the 3-step protection plan that most people never set up. By the end, you'll know more than 90% of retirees about keeping access to your own money. Let's get into it. So first, why are banks doing this? It comes down to 3 letters, AML, Anti-Money Laundering Regulations. After 9/11, the Patriot Act gave banks enormous power to monitor and freeze accounts if they suspect suspicious activity. And over the past 5 years, regulators have quietly expanded what counts as suspicious, especially for accounts held by people over 65. Here's what changed. In 2023, FinCEN, that's the Financial Crimes Enforcement Network, issued new guidance that classified large cash movements by seniors as potentially vulnerable to exploitation. The idea was noble, protect elderly people from scams. But the execution? Banks started using algorithms to flag any account with unusual activity if the holder was over 65. And unusual is doing a lot of heavy lifting here. What counts as unusual? A $15,000 withdrawal to help your daughter with a down payment. A $25,000 transfer to a new brokerage account. Even depositing a $50,000 inheritance check and then moving it somewhere else within 30 days. All of these can trigger an automatic freeze. And here's where it gets worse. Once your account is frozen, the bank has no legal obligation to tell you why. They just have to file a Suspicious Activity Report, ASAR, and wait. The average resolution time? 8 to 14 weeks. Some people wait 6 months. During that time, your money sits in limbo. You can't touch it. You can't pay bills. You can't access it for medical emergencies. I want you to really sit with that for a second. You worked for 40 years. You saved diligently. You followed every rule. And now the institution that holds your money can lock you out of it for months with zero explanation. That's the reality we're living in. But it's not just seniors getting hit. These same algorithms are being trained on younger account holders too. Banks are building profiles now. If you're 35 and you suddenly start moving larger amounts of money, maybe you got a bonus, maybe you sold a house, maybe you're starting to invest seriously. You're already being watched. The system is being built for everyone. It just starts with people over 65 because regulators think they won't fight back. Let me walk you through exactly what happens when a bank freezes your account, because understanding the mechanics is how you avoid it. Step 1. The algorithm flags your account. This is almost always automated. A computer program scans transactions and assigns a risk score. If your score crosses a threshold, the account gets restricted. No human reviews it initially. It's just code. Step 2. The bank files a SAR. At this point, a compliance officer might look at your account, but here's the critical part. They're not looking to help you. They're looking to protect the bank from liability. If they think there's even a 1% chance your transaction could be questioned by regulators later, they will freeze first and investigate later. It's not personal, it's risk management. Step 3. You're locked out. Online banking shows a generic error. Your debit card stops working. If you call customer service, you get transferred to a fraud department that tells you they're reviewing your account and can't give you a timeline. I've heard stories of people being told to just be patient for 3 months while their life savings sat inaccessible. Step 4. Resolution. Eventually, someone reviews your case. If you can prove the money is legitimate, tax returns, pay stubs, sale documents, gift letters. They might release the hold, but might is doing a lot of work here. Some banks require you to visit a branch in person. Some demand notarized affidavits. Some just drag their feet because they have 4,000 other cases in the queue. Now here's what most people don't realize. During a freeze, you're still responsible for all your financial obligations. Your mortgage doesn't pause. Your credit card bills don't stop. Your insurance premiums still get deducted, unless they bounce, in which case you get hit with fees and potential policy cancellation. The bank doesn't care about your cash flow. They care about their compliance checklist. And the worst part? There's no compensation. If the bank was wrong, if they froze your account for no good reason, and you suffered real financial damage, you have almost no recourse. The terms of service you signed when you opened the account almost certainly include language that lets them restrict access for security purposes. You agreed to this. Most of us did without reading a word. Okay, so now you know the threat. Let me give you the protection plan. This is what I wish my uncle had done. This is what I'm doing now, even though I'm decades from retirement, because the best time to set this up is before you need it. Step 1. Diversify your custodians. The biggest mistake I see is keeping everything at one bank. Your checking, your savings, your investments, your emergency fund, all under one roof. That's a single point of failure. If that one bank freezes you, you're completely exposed. Here's what you do instead. You want at least 3 separate financial institutions, not 3 accounts at Chase, 3 different banks or brokerages. I personally use one major bank for daily checking, one online high-yield bank for emergency savings, and one brokerage for investments. They don't talk to each other. They don't share risk profiles. If one freezes me, I still have access to 60 to 70% of my liquid net worth. Now, some of you are thinking, but what about the convenience of having everything in one place? I get it. It's nice to see one dashboard. But convenience is the enemy of security. The people who get wiped out are the ones who optimized for convenience. My uncle had everything at Wells Fargo. One freeze, 0 access, 11 weeks of stress. And don't just think about banks. Consider credit unions too. They're member-owned, which means they operate under different regulatory frameworks. Some credit unions are actually more conservative about freezing accounts because they don't have the same compliance infrastructure as mega banks. That can work in your favor. This one sounds extreme, but hear me out. You want physical cash and physical assets that you can access even if every digital account you own gets frozen simultaneously. I'm not talking about burying gold in your backyard. I'm talking about a structured approach. First, keep 2 months of expenses in physical cash in a secure location. A fireproof safe, a safety deposit box at a different bank than your primary accounts, somewhere protected but accessible to you. 2 months is the sweet spot because most account freezes resolve within 8 to 14 weeks. If you have 60 days of cash on hand, you can cover your essentials while the bureaucracy grinds forward. Groceries, gas, utilities, insurance, the non-negotiables. Second, consider keeping a portion of your emergency fund in Treasury bills held directly at treasurydirect.gov. These are government-backed, not bank-backed. If your bank freezes you, your T-bills are still yours. You can sell them and transfer proceeds to a new account if needed. It's an extra layer of separation. Third, maintain a credit card with a different issuer than your primary bank. If your checking gets frozen, your auto pay might fail, but a separate credit card keeps working. You can float expenses for 30 days while you sort things out. Just make sure you pay it off once access is restored. The goal here isn't paranoia, it's redundancy. Systems fail, algorithms make mistakes, bureaucracies move slowly. Your job is to make sure one mistake doesn't cascade into a financial disaster. This is the step almost nobody does, and it's the one that can cut your freeze time from 14 weeks down to 2. You need to pre-document the legitimacy of your money before anyone asks. Here's what that looks like in practice. Every time you make a large deposit, over $10,000 let's say, you create a folder with proof of where it came from. Sold a house? Keep the closing statement, the HUD one, the wire transfer confirmation. Got an inheritance? Keep the will, the estate distribution letter, the check image. Received a bonus? Keep the pay stub showing the bonus, the deposit slip, the employer letter if you have one. I know this sounds like overkill, but when a compliance officer is staring at your account and trying to decide whether to release the hold or kick it up to a supervisor, having documentation ready changes everything. My uncle's freeze took 11 weeks because he had to request documents from 3 different sources, wait for mail delivery, and then submit them through a portal that kept rejecting his file formats. If he'd had a folder ready, he could have emailed everything in one packet on day 1. I personally keep a money trail folder on my computer and a physical backup. Every significant transaction gets a subfolder with source documentation. It takes maybe 10 minutes per transaction, but if I ever get flagged, I can prove my money is clean in under an hour. And here's a pro tip that most people miss. Call your bank now, today, and ask what their specific process is for resolving account restrictions. Ask what documents they typically require. Ask if they have a dedicated team for senior account holders. Get names, write them down. If you ever get frozen, you're not starting from zero. You're calling someone you've already spoken to. Now I want to zoom out for a second because this isn't just about bank freezes. This is about a shift in how financial institutions view their customers. For most of banking history, the relationship was simple. You deposit money, they hold it. You withdraw when you want. The bank worked for you. But over the past 20 years, that relationship has inverted. Now, you are the product. Your data, your transaction patterns, your behavioral profile, that's what banks monetize. And when regulators come knocking, you become a liability to be managed, not a customer to be served. The freeze mechanism is just the most visible symptom of this shift. Under the guise of protecting seniors from fraud, banks have built systems that treat every large transaction as guilty until proven innocent. And because the systems are automated, there's no nuance, no context, just risk scores and thresholds. I think there's something else happening here too. As more people move money into crypto, into private investments, into alternative assets, traditional banks are losing deposits. And I don't think it's a coincidence that the same institutions seeing outflows are the ones most aggressive about freezing accounts. It's a way to slow the bleeding. If moving your money becomes risky and complicated, maybe you'll just leave it where it is, earning 0.01% interest while they lend it out at 8%. The counterintuitive thing about all of this is that the people most at risk are the ones who did everything right. They saved, they stayed liquid, they kept their money in safe institutions. The people who are harder to freeze are the ones with complex structures, LLCs, trusts, multiple jurisdictions. But most regular people don't have that. Most regular people have a checking account and a savings account and assume that's enough. It's not. If you're watching this and you're under 40, you might be tempted to skip this video. Don't. Because the habits you build now determine how vulnerable you are later. First, start diversifying your accounts now. Even if you only have $5,000 to your name, get a second bank. Get used to managing money across institutions. The muscle memory matters. When you're 65 and managing $500,000, you'll already have the systems in place. Second, start documenting your money trail today. That $2,000 you got from your parents for a car down payment, document it. That $5,000 bonus, screenshot the pay stub. The $10,000 you moved to start investing, save the transfer confirmation. You're building a habit that will save you months of stress decades from now. Third, have a conversation with your parents or grandparents about this. Most people over 65 have no idea this is happening. They think their bank is their ally. Show them this video. Ask them where their money is. Help them set up redundancy. Because when a freeze hits, it's not just their problem. It becomes the whole family's problem. My cousin had to lend my uncle $8,000. That strained their relationship. It didn't have to happen. And fourth, pay attention to policy. These freeze rules aren't set in stone. They're regulatory guidance, not law. If enough people push back, they can change. But that only happens if people know what's happening in the first place. Which is why I'm making this video. Look, I know this video was uncomfortable. I know it's easier to believe that your bank has your best interests at heart, but the evidence is clear. The systems are being built to protect institutions, not individuals, and the only defense is preparation. My uncle eventually got his money back, but he lost 11 weeks of peace of mind, paid $1,200 in late fees and bounced check penalties, and had to borrow from family just to survive. All because he kept everything in one place and had no documentation ready. Don't let that be you. Set up the 3-step plan. Diversify your custodians. Build a 2-month cash buffer. Pre-document your money trail. Do it this week, not next month, not when you're 65, now. If you got value from this, drop the word freeze in the comments so I know you made it to the end. And if you want to see how this connects to protecting your wealth from other hidden risks, check out this video right here on the biggest wealth killers in your 20s and 30s. I think you'll find it just as eye-opening. Thanks for spending your time with me. I'll see you in the next one.